So let me walk you through an example we have here, and we're going to call them Mr. and Mrs. Wonderful. I've changed their names for confidentiality purpose, but what we need to know is that the husband is 63 and the wife is 60, and they have combined almost $3 million saved for retirement. And we can see that 2.1 of that is in Mr. Wonderful's investment account. In this case, that is an IRA. And a little over 800 of that is in a joint tenants with rights of survivorship account. And that's just a stock account, a brokerage account that pays capital gains tax when we realize gains. And so many people would look at this and they say they've done a great job. They're in a great position. They can retire. And I actually agree with that. Now I'm going to take it one step further and say what was quietly lurking behind the scenes for this couple is that they were on track to overpay the IRS almost $580,000 in retirement because they didn't have a true plan in place. Now, Mr. and Mrs. Wonderful, they live in Texas, so there is no state income tax, and they are really in that retirement planning mode. And everyone's situation is different. Everyone's account values and how much risk they're willing to take and their cash flow income needs in retirement is different. But nonetheless, a plan is still needed because of that unique factor. In my opinion, most financial planning stops at the accumulation phase. Everyone focuses on that number that they need to hit to stop working. And that's a great goal and a great focus to have. But the second half of that is retirement. And I've never met a client who says they want to retire twice. You want to do it once and you want to do it right. And that's the distribution planning component. And what is distribution planning? It's exactly how much money we take out of which accounts, when we take it out, and how that money is going to be taxed over time. Hi, my name is Patrick Mundlin. I've been in this industry for 10 years, working with high income earners, high savers, and business owners to help them build financial plans that meet all of the intricacies of their goals and their lives today and for the years to come. So in this video, I'll show you in real numbers the dollars that this couple was set up to save in tax by taking one step beyond accumulation and looking at that distribution plan. Now, as we get into this, the software, it might look unique to you. It is a software that we use called Right Capital. And the goal of this is really to help educate clients and show what different scenarios and experiences might look like. And everyone's circumstance and tax environment is unique, and that's why planning in and of itself is unique. And what we're talking about today is a video that's intended for retirees or near retirees to really show them distribution planning and modeling for retirement and how taxes can have a long-term effect on that planning. More background on this couple, let's talk about their retirement picture. And so this couple, you can see we have a great score, 99% probability of success. We're not going to spend too much time talking about that. You might notice something, 16.2 million versus 15.8 million. We'll unpack a little bit today where that number came from, but you can see that Mr. Wonderful, he's going to retire at 63. Mrs. Wonderful, she wants to retire at 61, and their monthly need is $12,000 a month, and that is an after-tax number. That's what they need to live life the way they want and to be able to retire comfortably. So I want you to think of your retirement savings in three big buckets. You have your traditional 401k or IRA, which we get an income tax deduction on today, but we're going to pay tax in the future. And then you have your Roth. That's money that goes in after tax, but that money grows tax-free and we're able to take it out without any type of income or capital gains tax. And then the third bucket is what we call your brokerage account or non-qualified account. This is money that we've already paid tax on. It grows and we'll pay capital gains tax over time as those gains are realized. Now, most clients, they don't necessarily see all three buckets of money. They just see one really big pile of the total number they have saved. And I get that because forever what clients have focused on while they've been working is accumulation. Now, when they get to retirement, this is when it gets tricky. How the heck do you get that money out? Do you take it all out of the first account and then the second? Do you take 50-50? What do you do? And that decision has a profound impact on your taxes, or it could have a profound impact on your taxes during your retirement. For intents and purposes, this client is an aggressive investor. So we have them in a really equity driven portfolio, and those return assumptions are included later on if you want to really nerd out and dig into that. And we also gave them an inflation assumption or a pay raise every year in retirement so that they could keep up with inflation. And so there's a lot of assumptions in here. Every client scenario is unique, but we built those in to make this as realistic as possible. And what we're really planning for this client is from today until the day they pass away, which is in their 90s. And again, we had to make an assumption for that. And so what we see is for most clients, when they get to retirement, we hear this distribution planning topic come up and they say, well, I haven't thought of that, or my money manager has never had that conversation with me. And unfortunately, that's all too common. So you might be sitting here and saying, Patrick, conceptually I get it, but how does this math actually work when you're really unpacking a distribution plan? That's what we're about to talk about. When many clients get to retirement, what they want to do is they want to take assets either equally from accounts or pro rata. So what do I mean by pro rata? It means if we have $1 million total and $600,000 is in one account and $300,000 in another, we're going to take 2/3 from that $600,000 account. Why? Because it's 2/3 of our assets, and we're going to take 1/3 from the $300,000 account. Why? Because it's 1/3 of our assets. And logically, this makes sense. Many clients come up with their own game plan for distribution in retirement, but we're here to show the power that true planning can have on that. So when we get to this client's retirement plan, you can see that the reference strategy, which is what this client was planning on doing, was to invest their accounts in equities pro rata, so 2/3 and 1/3, equally split in equities and fixed income, and then pro rata withdraw. So take 2/3 from their IRA and 1/3 from their non-qualified to get to their income need in retirement. Well, when we built a distribution plan that customizes their equity allocation, that customizes which accounts they take from and when they take from them, and adds in Roth conversions, the impact of this is that this client will be set to pay almost $618,000 less than if they just went forward with their original plan. So here's what the client's current situation looked like. They come in pro rata, that's what they're doing. So year one, they'd be taking $54,451, age 63 for Mr. Wonderful, from a taxable account, which is a brokerage account, and then $132,779 from their income tax account. How did those numbers get put in place? Well, that's what they need, net of tax, by working with their CPA to get the number that they need accordingly. Now, one of the things I want to call out is at age 70, that's when the system had them taking Social Security. That was their game plan, was to take it at age 70. So you can see their income need drops a bit and they take less out. But what I want to do is I want to look at, let's call it age 80 for Mr. Wonderful. 2043. You can see his withdrawal from his tax deferred account is $302,000. Now that's a really big number, and you might be saying, well, why did that number get so big? And it's what's known as a required minimum distribution. It's the government's way of forcing us to take money out of accounts so that they can collect the tax revenue, because on the front end, they didn't tax that account. And that's money that's going to the IRS instead of remaining in our accounts, investing and compounding over time. Now, let's look at a proposed plan. So we did the math and we built the plan that was going to be the most tax effective and efficient for this client in retirement. Every client's scenario is different and we need to factor that in. So we're just talking about this client and their scenario. When we look at the details and we look at age 63 for Mr. Wonderful, you can see the first thing is we have a Roth conversion of $31,000 and change happening in that first year. Now, their withdrawal from their taxable account is substantially higher, and their withdrawal from their tax deferred account is substantially lower. Now, as time goes on, you can see again the income dip happens. We're keeping Social Security the same for conversation's sake, but then starting at age 73, their withdrawal from their tax deferred account begins to pick up because we've already taken advantage of our conversions here. And as time goes on, when we come down to the same thing, Mr. Wonderful, age 80, that distribution is $287,000 instead of the $300,000 number before. So it's $20,000 less, but that $20,000 is money that we're not taking out that the government is forcing us to pay income tax on. Now, as we're talking through this, most people assume that Roth conversions mean you have a tax-free bucket you pull from later. That may be true. What I want to show you for this client is this tax-free account, and you can see that they're never actually planning on taking withdrawals from it. In this scenario, the Roth conversions is not to have money to take out tax-free in the future. It really is to minimize the impact of required minimum distributions. And so as we look at this, pro rata wasn't wrong, it just wasn't optimized. And what closes that gap is really the distribution planning of retirement. Which accounts we pull from, when we pull from them, and how much we take. So what I have here is a projected tax return for a client at 2040. Same client that we're talking about earlier, Mr. Wonderful, and you can see that without conversions and distribution planning, his total tax is listed to be at $75,000. Now, let me pull up the one that shows his conversions earlier on. Now, with conversions, you can see the same tax analyzer. His total projected tax is to be $40,000. Now that difference of $15,000 is because we did Roth conversions on the earlier side of their plan. And that's money that stays in this client's pocket, growing and investing for a long time to come. What's powerful about this is that gap actually gets bigger every single year because of how the government forces out money via required minimum distributions. So what does this mean to you? If you're already retired and you haven't had a distribution plan run for you yet, I'd strongly encourage you to do so to make sure that you're doing everything you can to keep more of that money that you work so hard for instead of letting the government tax you more than is required. If you're not yet retired and you're really prioritizing saving to that tax deferred bucket, I love the aggressive saving, but stop and ask yourself the question, is this truly the best place to be saving? Or is there a more optimal account and saving strategy for me and my family as time goes on? And here's the thing about planning for clients. When you're looking at taxes, it's not just a snapshot in time, although this year is very important. It's really building out that lifetime tax bill. Now, I hear all of the objections from clients all the time. I make too much money to do a Roth, or a conversion just doesn't make sense. And my question would be, if you've seen the math and the math says that, great. But if not, go get the math done and see what your plan says for you, because every client situation is unique. Now, it is true that Roth access, the government makes it very difficult to get your hands on. It makes it hard to access that dollars because of income limits and contribution limits, but there are strategies available to each and every one of us in America to get Roth dollars. It's just about building a plan of executing how we do that and what the tax impact of that will be. Now, the last thing I want to show you for this client is their conversions. Starting in 2026, we're doing their conversions to keep their income in that 10% bracket. Why? Because the math says that's the optimal bracket for us to convert in to have the greatest tax arbitrage over the course of their retirement. Now, for everyone, this answer is different. For some, it could be save to a Roth today or a Roth 401k today. For others, it could be execute a backdoor IRA. And for some, it could be just do conversions in retirement based on what the math and your own planning dictates. Now, in my opinion, the worst phrase I ever hear is, I'll worry about that in retirement. Because what that usually means is the problem is more complex, it's going to cost more tax dollars, and it's going to be harder to solve. And now, that is exactly my job. It's to cut through the noise, and it's to provide clarity on exactly which strategies make sense for you, when it makes sense to execute upon them, and to show you the math with a given set of assumptions of what that impact could be. So if you're sitting here thinking, Patrick, I want to know what my plan looks like, click the link below. You can send me an email or go to my website and schedule time to talk, and I'd be more than glad to walk through this with you. Now, again, I want to say this can depend on so many factors. How old you are, what account you have money saved in, how much you have saved in each of those accounts, even the state you live in and the state income taxes accordingly. And this worked for this specific couple's situation. Your situation, the numbers are going to be different. Your goals and priorities are going to be different. And chances are the math is also going to be different. And that's why planning is fully customizable to each client that we work with.